Welcome to Talk Tickers. Today, we're digging into a really fascinating one. Cable One's Q2 2025 earnings call from July 31st. The results came out and, well, what happened with the stock next was probably not what most people were expecting. All right, let's get right into it because this is one of those head scratchers. You see a massive GAAP loss per share, a negative $77.70. And then the stock pops almost 7% the next day. What is going on here? We're going to unpack that exact disconnect for you. So yeah, a loss, but a rally? It really all comes down to what the market decided to pay attention to, and maybe more importantly, what it decided to just completely ignore. So that huge loss we just saw, it all boils down to this single number, $586 million. Now, this wasn't cash out the door. It was a non-cash impairment charge. Basically, it's an accounting write-down on the value of their assets, which, ironically, was triggered because their own stock price had fallen. And management was crystal clear about this on their call. They basically said, look, this is an accounting entry. It doesn't change our cash flow. It doesn't change our strategy. It doesn't affect the actual business at all. And you know what? The market listened, and it completely agreed. All right, so let's talk about the numbers that actually mattered. If Wall Street shrugged off that big accounting charge, what were they looking at instead? Let's get into the real operational story. Okay, now this is where the real story is. Take a look. Yeah, revenue and EBITDA are down a little bit year over year. That's not a huge surprise. They're losing some of those old school video customers. But look at the margins, rock solid at over 53%. And this last number, Adjusted EBITDA minus CapEx, that's basically their cash flow. And it's stable at a really healthy $134.8 million. That's what investors were focused on. So how did they pull this off in such a tough competitive environment? Let's look at management's damage control playbook. It's all about financial discipline, and it's a story the market clearly loved. It's really a classic blocking and tackling strategy. First up, pay down debt. They're getting aggressive here, chipping away over $70 million in the quarter plus another $25 million in July. Second, pivot to data. They're letting the low-margin legacy video business fade while really focusing on the profitable stuff, high-speed data for homes and businesses. And third, simplify. They're cleaning up their pricing and marketing to stabilize their customer base and just compete more effectively. And this brings us to the big question, why the market bought in. It's really that simple combination. You've got steady cash flow plus a disciplined plan, and that is often a recipe for outperformance. And wow, does this chart tell the story or what? Just look at this. In the month right after that earnings call, Cable One's stock was up over 23%. Now compare that to the rest of the communications sector, which was up just over 6%. That's a massive difference. Investors were basically shouting, we don't care about short-term subscriber noise. We care that you're fixing the balance sheet. So let's break down the market's verdict here. At the end of the day, investors saw a company that just keeps pumping out solid free cash. They saw management getting serious about paying down debt, which signals real discipline. And they saw a company that could keep its margins stable even when revenue dipped a little. You put all that together, and the market decided management's strategy wasn't just talk. It was credible, and most importantly, it was working. All right, so that brings us to our favorite part, the next call. Where do we think this stock is headed from here? Let's lay out our view. We're initiating our coverage on Cable One with a market perform rating, and here's what that means. We think the stock is probably going to perform right in line with the rest of the communications sector for the next 6 to 12 months. Look, the company is doing a great job managing what it can control, but those competitive headwinds from fiber and fixed wireless are very, very real, and we think that's going to put a ceiling on the stock's performance, at least for now.
So what are we going to be watching for on the next call? Well, here are the key things. First, and this is the big one, subscriber trends. We need to see any sign that they're stopping the bleeding in residential broadband. Second, debt reduction. Are they keeping up that aggressive pace? Third, we want to hear more about their enterprise fiber business. That's a huge potential growth area. And finally, ARPU, average revenue per user. Management guided that it would hold steady, and we need to see them deliver on that promise, especially since they're also forecasting that overall broadband revenue will be flat to slightly down in 2025.
So our final call is market perform. Plain and simple, this is a really well-run company that's just stuck in a very tough industry right now. And we believe the current stock price pretty much reflects that dynamic. And that leaves us with the big, lingering question you see here. In today's telecom world, with all these competitive pressures, is just being disciplined and paying down debt enough to really create value for shareholders? That's what we'll be watching over the next few quarters. As always, this is not financial advice.